Hi, I'm Jessica Irving Marshall, and today I'm going to be presenting a video on QSBS treatment and a little bit more information since we are having such an influx of clients that want information about Section 1202 and the QSBS treatment. And so we're hoping that this provides a little more clarity. So like I said, this is qualified small business stock, also called the QSBS. It is under IRC Section 1202. We're going to go through the 4 pillars of qualification, the OBBB enhancements, Section 351, a 409A valuation, and 83B intersections, and overview of the documentation that helps to defend these for our clients. So this deserves attention from day one because it is one of those goodies in tax code that seems too good to be true, but it is not. 100% federal gain exclusion available for qualified stock held for at least 5 years. And we'll get into the nuances of OBBB and what that gave us in the 3 and 4 year sell potentially. And then $15 million per issuer cap for post OBBB or 10 times the basis. If 10 times the basis is higher, that is what can be taken as the tax exclusion. The aggregate gross asset ceiling was lifted from 50 million up to 75 million. And then day one, the qualification and the defense file both need to be correct at formation, not exit. This is not something that can be cleaned up later. The qualification is claimed by the selling shareholder, and the burden of proof rests on the taxpayer for the entire holding period. Also rests on us as their CPA as well as corporate counsel. So mishandled requirements can permanently disqualify the exclusion. So again, like anything in the tax code, anything that says up to 15 million or 10 times basis excluded from taxes, you better be ready to have all of that documentation ready at the beginning. Here are the 4 pillars. C Corp needs to be a C Corp, can't be an S Corp. They never qualify, which I will repeat again and again throughout this presentation. Original issuance, this means acquired directly from the corporation for money, property other than stock, or as compensation. Secondary purchases never qualify. Gross assets test at or below the applicable ceiling, either before OBBB, which would be the 50 million, or post 75 million. Active business, at least 80% of the assets being valued or used in the active conduct of a qualified trade or business, all of the holding periods. Each pillar has the technical nuances, and we will get into these. So what qualifies? C Corp, domestic, US-based C Corp at the time of stock issuance. C Corp status maintained for substantially all of the shareholders' holding period. Eligible corporation status needs to be monitored over the life of the position. It's not just one and done. You don't test once and then leave it. What disqualifies? Again, I said I would mention this many times. S Corp never qualifies. Even if the company later converts to a C status, we need to be coming in the gate as a C Corp. An S election by a C Corp strips QSBS status from all outstanding shares, and converting back does not restore it. Excluded entity types under Section 1202. These are listed here. The RICs, the rights, remix, discs, cooperatives. Know what those are from the beginning and don't try to qualify for this. The original issuance needs to be direct from the corporation. So stock must come to the corporation directly or through an underwriter in exchange for money, property other than stock. So think of that as, as real property. Compensation for services, that's where we get into some of the RSPAs and the 83Bs. Stock purchase from another shareholder in the secondary market does not qualify. So options in the clock. Options themselves are not QSBS. Only shares received on exercise can qualify, and the holding period begins at exercise when actual shares are issued, not at grant. Transfers that preserve the status, QSBS received by gift, through inheritance at death, or as a distribution from a partnership, generally retain their status, as can replacement stock in certain Section 368 reorgs. Gross asset test, 75 million needs to be measured carefully. So aggregate gross assets means cash plus the aggregate adjusted basis of other property, tested before and immediately after each issuance. Contributed property counts at its FMV at contribution, not carryover basis. So remember that FMV is going to be a bump up if that's higher than the carryover basis. Threshold by issue date, $50 million for stock issued on or before the OBBB, which was July 4th, 2025, 75 million after that date, index beginning in 2027. Subsidiary look-through, the assets of subs consolidate where the corporation owns more than 50% by vote or value, which can push a thin parent over the ceiling. So make sure that you're looking through the subs. Planning headroom, bonus depreciation, and immediate Section 174A expensing can reduce adjusted basis, creating room under the ceiling model before each raise. A company worth less than the ceiling and a company that satisfies Section 1202D are not synonymous. The statute tests gross assets, not enterprise value. Active business requirement, 80% asset test, which is very important here, especially when the thing being sold is software that sometimes has a consultation component to it that puts it more into the bucket of SSTBs. So at least 80% of assets by FMV are used in the active conduct of qualified business during substantially all of the holding period. Working capital counts only to the extent reasonably needed for operations. Excess cash, portfolio investments, and non-operating assets erode the ratio. They start encroaching on that 20%, where again, even a 1% going over to 21% can completely upend QSBS. Excluded businesses under 1202E, so these are the SSTB, specified service trade or businesses like me, an accountant, law, health, engineering, architecture, actuarial service, performing arts, consulting, athletics, financial services, and brokerage. If the principal asset is the reputation or skill of the employees, they are disallowed. Banking, insurance, financing, leasing, investing, farming, extraction, hotels and restaurants, real property ownership, and rental, all excluded. So think of it as this was written towards a US-based company that is producing a thing. Someone has a factory producing hammers. They are tangible, they are a product. The loophole that so many of our clients are coming under is the software development because it's an intangible asset. But watch for the SSTB. And again, with companies, if there does end up being a built-in consulting revenue adjacent to this QSBS company, look at a new entity. And then you can look at the S election and you can look at reducing your taxes through the self-employment tax, drilling that to the Schedule E instead of a C with the S election, but keep it separate as its own entity. Software companies are products, not personal services. And this is why we have had such a large influx to our practice. Most of our clients are coming through as software companies. So software companies create and sell a product, the software itself, which is an intangible asset, rather than selling primarily the services of their employees. That distinction separates them from excluding consulting businesses. The 1202E8 supplement, which is rights to computer software producing active business computer software royalties within Section 543D1, are treated as active business assets. Treat this as a supplemental rule. An operating software business can satisfy generally the 80% test independently. Sole founder question, reputation or skill exclusion asks what the principal asset of the business is. Subscription revenue from customer access to a product supports an IP characterization. Document the model, the code ownership, revenue character at issuance. This brings in as well IP law to ensure that you have your patent attorney and your copyright trademark in there to value that IP. Because as we go back to that gross assets test, IP counts. So if you accidentally create IP that ends up ballooning in value and goes over the 75 million, that needs to be part of the valuation. And remember, have the valuation done by a qualified independent valuator, and we have some very good referrals for who can be used with reports that can stand up to scrutiny by the IRS. So this is before and after the OBBB. So before January 4th, $10 million cap or 10 times basis, 50 million gross asset, all or nothing 5-year holding requirement. You have to hold the stock for the 5 years to cash out and make your 10 million or 10 times basis tax-free. There was no inflation indexing. So after July 1st, 2025, and here's a little aside, if you started before, there's no way to really reorganize and have the same company exist after July 4th, so you get the better qualifications. That's a no-go. The IRS sees right through that. We don't do that with any of our clients. $15 million cap or 10 times the basis, and it is indexed beginning in 2027. So we will see this indexed and moving upwards. Most likely. $75 million ceiling, and again, index beginning in 2027. So we can expect that to move with the indexed inflation. Graduated exclusions start at 3 years. This is part of why we are seeing people coming to the QSBS model, because investors now see that they can have an out at year 3 at 50%, out at year 4 at 75%, 100% after year 5. The requalification for window for companies between the old and the new ceilings, acquisition date cannot be reset. Like I said before, you can't exchange pre-OBBB QSBS for newly issued stock. The IRS sees right through that, as do we as the CPA, who needs to do the documentation to help you to enjoy 15 million tax-free. Start a new company with an entirely new product, then we could talk about post-OBBB. So this is what I talked about with the graduated exclusion schedule: 50% after 3 years, 75% after 4 years, 100% held at least 5 years. And then I have in the slides the effective federal rate and what that means after tax. The gain constituting the Section 1202 gain under Section 1H7, the portion taxable solely because of the percentage limitation falls in the 28% tax category of Section 1H4. State taxes are additional, and conformity, which I'll get to conformity on a slide and why that's important. Multiplying the per issuer per tax cap. Gifting and trusts, each taxpayer carries a separate cap. So gifting QSBS to family members or non-grantor trusts before a sale multiplies the aggregate exclusion, and trust in a no income tax state can address the state layer. Basis stacking, so contributing additional property for QSBS raises the aggregate basis, which can make the 10 times basis cap the binding limit instead of the flat dollar cap. One other thing to keep in mind for more of the complex companies here is for the multi-issuer diversification. The cap applies per issuer. So QSBS position in several qualifying corporations each have their own exclusions, which is where a lot of investors are getting very excited as they're dropping relatively smaller investment of 1 million to 3 million across multiple companies, hedging to see who is going to be successful. Those can all stack. There's not a limit on those. So every multiplier depends on the underlying stock qualifying in the first place, which returns us back to what we do as the CPA working with the tax attorney to make sure that this qualifies from day one. So Section 351, which is the tax-free transfer of assets, is very important. This intersects with QSBS almost in probably 90% of the work that we do, because these end up being tax-free transfers. So transfers must own 80% of voting power and 80% of each other class immediately after the exchange, tested independently, and control must be effective rather than transitory under a prearranged plan. Section 1202I basis, the contributed property gives the stock a Section 1202 basis of not less than the FMV, fair market value at contribution. Pre-contribution built-in gain is not excludable, and the same value enters the gross asset test and sets a 10 times basis cap. Pitfalls: boot, liabilities exceeding basis under 357C, stock issued for services, that sweat equity investment company transfers under Section 351E, and an inadequate return documentation each threaten the result. There's the assets up, assets over, and the interest over, which are the conversion mechanisms under 351, which we have some other documents that go into that in detail. Just make sure you know those and make sure it's structured correctly by your corporate counsel and that your CPA is signed off on that as well. A Section 409A valuation are for options that are exempt from Section 409A, require an exercise price at or above the grant date fair market value, supported by an independent safe harbor valuation. That independent valuation is very important. There are online options for valuators, and again, before procuring a valuation from an online evaluator, make sure that they will work with your CPA, someone like me, and defend that valuation should you make, let's say, 75 million, which is your 10 times the basis in year 5. You want to make sure that you can rely upon that valuation. So the valuation is not the point at which to be cheap. Having an independent valuator, we have some great recommendations to colleagues that we trust and whose work that we feel confident in working with, that can make sure that they can support that valuation. Because like I said, you mess up in one single technicality and you could blow the entire QSBS tax-free taxation on a technicality. Corporations' own CPA cannot perform the valuation. We have to be independent. So even if I looked at the valuation and I knew that this was exactly what it was valued for, I'm not independent as a CPA. I'm advisory. Where no options exist, no safe harbor valuation is required, but contribution date value still matters for Section 1202. The Section 83B election is for restricted stock. The election starts the QSBS holding period at grant rather than vesting. There is a hard and fast 30-day deadline in statutory and absolute. You need to electronically file the 83B, which we are so excited that there is this electronic filing option now. This is relatively new. It used to be certified mail only, and then we would quite literally hold that certified mail for a client in their permanent files, because we have had clients who cash out and the IRS has no proof that the 83B was mailed. We're able to show the certified mail receipt from years ago, and that is the difference between the 83B election being had or not had. So the Form 15620, great. I'm also, just because I'm a 50-year-old CPA, we also do the certified mailing with that, just so we have both bases covered. Early low valuations lock in the minimal ordinary income and convert future appreciation to cap gain within the QSBS framework. So fully vested shares issued for contributed property require no election. So if you're fully vested, you're not doing the 83B. But for restricted stock, the documented omission is the correct answer. So you need to file the 83B if you are receiving the restricted stock. There's no way around that. Like I said, it must be done within 30 days, no exceptions, nothing, none at all. That I know of. Tax attorneys, I believe that there have been some articles on the nuances there, so I defer to legal for there. For me as a CPA, 30 days. Corporate level file. So the formation documents, articles, bylaws, evidence of C Corp status from inception. Again, work with corporate counsel on that. Complete stock ledger and cap table, dates, consideration, and holders. There's some great online options, the Carta, Cake, As long as you have that in there and you're compliant, keep the cap table. Gross asset calculations documented at each issuance before and immediately after. So anytime you are issuing the stock, have that valuation done. We usually see these valuations done at least yearly, but then remember that any material event could trigger the need for a new valuation. So when in doubt, reach out to your CPA and corporate counsel and ask, hey, is this material enough? And we'll say, yes, you have an investor who's infusing you with $25 million. That is material, and let's have a new valuation. Annual active business analysis, 80% of assets by value and qualified use. Again, look for software, look at that consulting. If you're developing this great consulting practice that organically is popping up, it doesn't mean that you can't do that, but just open a new entity, do that consulting separately from this QSBS company. Business activity records proving a qualified trade and not an excluded service business, the SSTB. Someone like me, if I happen to figure out computer programming and can create a software asset that will rival the wonderful Thomson Reuters UltraTax software that we use. Not that I have any interest in doing this, but that could actually be a QSBS company selling software. But if I am trying to pass myself off as a CPA with Moss that I've been doing for 26 years and all of a sudden claim that it's not, it's a thing I'm selling, that's a no-go. All historical 409L valuations with board minutes approving grants, keep those. We keep them as CPAs, corporate counsel keeps them. File the 1120s. If you're doing a tax-free 351 transfer of assets, document that with both returns. So with the final, if it's a 1065 partnership, if it's a final, if a diseroded entity on your 1040 or an 1120S, it always helps to keep that 351 substantiating documents that we write as CPAs that confirm that this is tax-free treatment. File it with a return. Do it as a PDF attachment, keep it in your tax file, and then file that as well with the new 1120. The corporation builds a record, but the shareholder claims the exclusion. So annual attestation letter that comes from the independent valuator bridges the two. And we as the CPAs and then my corresponding corporate counsel, we make sure that everything is going well in our lanes of authority, being law for the attorney and then tax for me. So the shareholder file and ongoing monitoring, this we've covered already. The shareholder documentation, executed stock purchase agreements, show consideration issuance date. Keep these, memorialize them, make sure that they're done by a real attorney. Filed 83B elections, again, show that electronic proof. In my opinion, we are still going to be sending them in certified, keeping that receipt. Option exercise records, date, price, shares received, annual QSBS attestation letters from the corporation. We also write these as CPAs, stating that everything that we oversee is being maintained. Continuous ownership records from acquisition through sale. Again, record keeping is key to all of this. And then the ongoing monitoring, we, along with the valuator counterpart and legal, sometimes need to be doing quarterly review of the asset composition, just if it's dynamic, especially if it's gaining value quickly. Updated QSBS analysis at each anniversary and or material event. So when in doubt, you reach out to your CPA and say, like I said, hey, my grandma is kicking in $5 to this corporation. That's not material. I don't know. Maybe it is, because maybe you'll turn that into 25 million. But if you have someone coming in, or if you have a new software line that is going to be highly lucrative and you have it patented, that's a valuation update. And then we need to look and make sure that this is staying under that $75 million cap, or is it time to potentially start a new company that holds that asset and the income activities pursuant to it. Redemption tracking against the de minimis thresholds, legislative and IRS guidance monitoring for rule changes. This is part of what keeps me in business and ensures that I will never get to retire because AI takes over for me, because Congress, this was memorialized in OBBB, so we take that as lasting for eternity. until or unless something changes. So we have to look over this. We have to stay abreast of what's going on in Congress and at the state conformity levels, which I get to. This is what can disqualify automatically. S Corp, an S Corp election, you're done. That's it. Enjoy the pass-through taxation, enjoy the Schedule E, shielding some of that income from self-employment taxes. Don't hold real estate in that S-Corp, but you're done. Active business breach, excess cash, portfolio investments, or a drift into excluded activities below the 80% line. Don't use these as a front. Use them for what they are meant to do, which is the active business of a thing, whether it's intangible or tangible. Significant redemptions, purchases from the seller within 4 years or from all holders within 2 years, unless within the $10,000 and 2% de minimis limits. If you want more information on that, reach out and I can talk your ear off and show you some other writing about that. Business character change, a pivot from product to consulting during a substantial portion of the holding period. Like I said, do not feel like you have to completely stop your creative vibe and your ideas for the consulting that comes up. That naturally and organically happens with these companies, but you're going to need a new company for that. Offshore development, so intangible heavy companies risk the active business analysis when the development moves outside the US. This was built as an incentive for US-based businesses. There's also R&D, which you can see some other videos about, and how that's either amortized or expensed. But look at the other video for that and our writing. And then a non-qualifying transfers other than gift, inheritance, divorce, or partnership distribution, generally end QSBS. At the little bottom footnote is that most disqualifying events are preventable with a quarterly monitoring cadence from the substantiation program. And that's what we do for a living, is to help people sleep better at night. We don't sleep well at night because we see, oh, you've got consulting income that you forgot to tell us about, but okay, look, we only got up to 10%, not too late. When in doubt, loop in counsel and your CPA. Conformity varies. This is what I was talking about with states. So July 4th last year is when OBBB hit. So there's still a bit of a scramble, and there's still some of those provisions that if anyone was preparing tax returns, you can see that it was clunky this year, rolling out some of these things. No tax on tips, things like that. They were a bit clunky. So no conformity as of 2025. Those are the states. But I know this is outdated because New Jersey, I'm pretty sure I read, is fully conforming now. So I think that this slide is already stale. I'll have to send this back to my team. The point of this is that the partial or delayed, I'm sure California is not. That will be national news. I don't know what makes national news nowadays, but to me as a CPA, that would be national news if California conforms. But look at New York conform, but maybe a delay. And then all of a sudden we may see states competing to compete on paying zero taxes, because if you make, $15 million and there's no state tax, that's huge. So planning strategy, non-grantor irrevocable trust in no income tax jurisdictions, Alaska, Delaware, Nevada, South Dakota, Wyoming can potentially hold QSBS free of both layers with careful coordination among legal, tax, and fiduciary. I'm the tax person, and this is why we see a heck of a lot of businesses being set up in Wyoming, despite there not being that many people there. This is why. 8-point checklist, you can review this structure correctly. Document 351, document the heck out of that, file it with the tax returns to which it is important, because we want that closing pass-through entity to prove to the IRS at the form. And again, this is my opinion. Do a PDF attachment that documents that 351 tax-free transfer on both the closing pass-through entity and the new C Corp. You can't ever miss the 83B deadline. Hard and fast. Just don't miss it. That's the best way to avoid that. Maintain the valuations, again, at least annually, in my opinion, and at material events. Ask us, ask your attorney if it's material, use common sense. Monitor continuously assets, activities, redemptions. Quarterly is a good cadence to have. File your returns. Late filings undermine the QSBS claim. If I have a client who is behind for 3 years on their 1120s for no reason except they didn't feel like getting their QuickBooks updated, that's a problem. And those are the bad facts that would make me unable to defend this to the IRS as tax representation. Engage qualified advisors, CPAs, attorney, valuation professionals. AI is fantastic. AI can get you, especially to some of these answers that can take things off of my plate, but replacing me or an attorney or a valuation professional with AI is fraught, because that AI bot would need to show up to defend this for you when you make your 15 million or 10 times basis and cash out. And they're not great yet at seeing any AI robot show up and be accepted into the court or jurisdiction. So this qualification begins at formation, so does the file. If I can just stress this enough times, just please document everything. Watch videos like this, read our articles, reach out to our team if you have any questions. We're always here to help. And we have a pretty full practice, but we are expanding, and we also work with a lot of really good CPA firms who are able to work with us. Great corporate counsel we can recommend, and great valuators. Thank you for suffering through another one of my videos. I appreciate it, and I hope it was helpful.